quite considerably, and there's greater macroeconomic stability. And that's of significant benefit to all of those economies. And it's one of the reasons why in the kind of macroeconomic and monetary side, they were relatively unaffected by the crisis. And part of the reason for that is that at the kind of debt level, the problem is not servicing a debt. Actually, if all you're trying to do is service a historic debt, it's a pretty good time because interest rates are very low. The countries that are really suffering problems are the countries that have to continually borrow to refinance their large debts. Especially, that's the problem in the European economies. And particularly the most affected is that they put themselves in a position where they have to borrow more every year just to refinance the debts they're accumulating. And they're suffering for that reason. They got themselves into a stupid situation, and now they're paying the price. Fortunately for Africa, many of them didn't get themselves into that position, perhaps because maybe they got some good advice from people like the World Bank in the 1990s that inadvertently put them in a better macroeconomic position.
Crisis on capital flows. Some countries have been affected by FDI inflows. Some have been impacted by portfolio flows. In some cases, trade finance has become very difficult. In other countries, remittances also have come down. And last but not least, some ODA flows also have dried up. So Professor Kramer will discuss these issues.
Is this on now? Okay. Yes, the impact on capital flows in 6 minutes. This is really a challenge. I think I can only sketch some influences, and I try to cover as most as possible and as quick as possible, and maybe then we can have some more questions in detail. Okay. Well, we can distinguish between the impact on debt finance and on equity finance, and then also, as you mentioned, on some flows of income like workers' remittances and also official development aid. Well, debt finance and equity finance, the main difference, I think, is that debt finance requires fixed payments of those countries, nations, or firms that got to be financed through these channels, fixed payments regardless of the state of the economy or of the state of the firm, whereas equity finance means that its value of equity fluctuates strongly with aggregate demand and with output, and this makes things different. So in one case, one side has more advantages, in the other case, maybe the other side. Now, first thing with debt finance, of course, finance through bonds. And we've all heard about the sovereign debt crisis, and my neighbor already mentioned the European situation. The problem is with a situation like in Europe and with sovereign debt crisis, as we've seen in the past, that there are very strong contagion effects. So this debt crisis may spread over to other nations, and if lenders worldwide lose the confidence with this kind of finance, then they might refuse to further lend. And you know all about the problem of sudden stops. Financial flows suddenly stop running to developing countries, and we have this case of self-fulfilling prophecies. If everybody thinks there will be a nation, a country that might default, then in most cases this default is unavoidable unless you have a strong lender of last resort. This is something I will go into it with the European Monetary Union crisis tomorrow, whether we have this lender of last resort or not, and developing nations usually have with the IMF. But when the European crisis demands great funds to rescue maybe not only Greece but also Spain, there might be a running out of funds also for other nations in the developing nations world. Second thing, bank finance. Also here, most of you are familiar with the situation. We have seen a huge banking crisis in the US that spread over also to Europe. In Spain, many banks are still in danger. We try to make a shelter like a banking union, which is a very, very difficult political process. And if a banking crisis in our financially interlinked world spreads up, then we can see also effects in other places in the earth, because banks have now so many interrelated stakes and equities, and sometimes we all do not know where this then spills over. So a credit crunch might be a danger when a big banking crisis could emerge. So I hope we can prevent this, but we have the problem of bailout banks, and when you have government debt, so there's also interrelation between these two factors. Who can bail out banks if government debt is already very high? Third point of debt finance is official lending. Official lending is similar to development assistance, official development assistance. Also, this is a question of finance. If the rich countries in the world got their own problems, it is understandable to some extent that they cut back on these expenses to some extent. I will go into it in a second. Let me come to the second phase or second type of finance. This is equity finance. As I said, the value fluctuates depending on aggregate demand and output. This can be an advantage for the holders or the takers of the credit, but also sometimes it's a problem. We can distinguish FDI and portfolio. Usually you say portfolio as a long-term investment is preferential to portfolio. But also here you get a problem. If a big crisis would emerge, then you want to acquire additional amounts of foreign direct investment, and there will be a stop because capital is then very careful to go, especially abroad. Maybe it will be invested at home. Maybe also we get a situation where we have capital controls and, many other evil things I do not want to think about that can come if we see the European situation. Portfolio investment is more short-term, but we have today a globalized capital market. There are many opportunities for investors. They quickly go into a country and they quickly go out, especially in currency market we see this. And this is why we think about maybe brakes on those things. And I don't know whether you have heard that in the European Monetary Union, we have now a majority of nations that agree on a financial transaction tax, the Tobin tax. For a long time, this was opposed by many. But last week, we had the majority stake. We reached this, so probably there will be, in the near future, such a financial transaction tax. And let's see how this will work on the portfolio market. Okay, number 2, workers' remittances. If I have some time left, it's a very important. 1 minute, okay. So I might concentrate on workers. Yeah, you're right. Now, what I found interesting is the importance of workers' remittances. In 2011, we saw $372 billion going to families from foreign workers, and unlike foreign direct investment and also portfolio equity and private debt that went down through the crisis, workers' remittances is remarkably stable up to now. However, what we can observe in crisis countries in Europe, especially in Spain, where the unemployment in the native born increased from 2008 to 2010 by 8%, the unemployment rate of foreign workers increased by 16%, so it doubled. Usually those workers are the first one who lose their jobs, and also this might then endanger workers' remittances. As I said, so far it's quite stable, but when the crisis deteriorates, maybe also this source, very important source of capital flows, will come to an end or will go down a little bit. So I think I have to stop now. Thank you.
Sorry, I must apologize, for giving you only 6 minutes. In fact, had I not intervened with my 2 good friends, who asked me to chair this meeting, there would have been 8 of us. So fortunately, we brought it down to 4. In spite of this, it's a bit very unfair to ask someone, to discuss the broad implication, of the financial crisis on investment within 5 minutes. But I hope we're going to catch up, during Q&A. The next speaker would be Professor Grandberg. He's going to flag some issues, in macro policy making for Mauritius as we go forward in the context of the crisis that has affected our country. Professor.
Thank you very much, Chair. I really can't resist, I'm a weak man, Professor Oliver, my friend over there, his comments about the good advice we've gotten from the World Bank and IMF. Just 3 examples, 2 from Botswana and 1 from Papua New Guinea. The World Bank told us not to buy shares in mining companies, and we didn't listen. And now our shares in De Beers are our biggest source of revenue. Thank God we didn't listen. The World Bank told us not to build electricity power stations because the South Africans can do it better. Now I sit in the dark 2 days a week because we did listen to the World Bank. And in Papua New Guinea, when I lived there, the World Bank told us to impose user fees on primary education so that we would give workers an incentive to earn monetized income. And as a result, all girls were thrown out of school because families couldn't afford them. Thank you for the good advice. Sorry, I've taken 1 minute, but let's now get to the point. Now, I spent all of my life in small economies. They are inherently cost disadvantaged by virtue of their smallness. This is compounded by isolation, and when they are island or landlocked, this tends to raise their costs even further. So how does a country which has an inherently high cost structure by virtue of what it is compete in the global market? The simple fact is, if you look at most small countries, they produce nothing unless there is a quasi-rent embedded in the price of the product that they are exporting. And that can either come from preferences, and Mauritius is the case par excellence of having those preferences, or it can come from the quasi-rents embedded in the price of a mineral or natural resource, or it can come from a quasi-rent provided by the state. Otherwise, if you don't have that quasi-rent in the price, you have to adjust your factor prices downwards to make you competitive. But if the magnitude of your cost disadvantage is so large, you end up producing nothing, all right? Because there is no above zero factor price that will allow you to produce. This is a horrible fact. There are countries on this planet that produce nothing except misery. They export their people, all right? They live off remittances and aid. The most extreme of small microstates, this is a common case in the Pacific where I come from. Now, Mauritius has until now made very effective use of the preference regimes that it's had. The Sugar Protocol provided massive quasi-rents that were accumulated in the hands of the Grand Blanc, all right, who then used those, who used that investable surplus to develop tourism and the textile industry. All right? We dissipated that surplus in Fiji, where I lived most of my life, by sharing it equally amongst the poor. All right? We redistributed that wealth. You did not. You concentrated that wealth. And as a result, you are where you are now, in large part because of that. It's, again, an unfortunate fact of life. Now, followed by that, you had a series of preferences in the textile and industrial sector which permitted production at prices that would not have been possible had there not been a preference embedded. The third element, which has moved you from a transformation from agriculture to industry and now into services, is the double taxation agreement with India, which costs the Indian Treasury somewhere between 600 million and $1 billion US every year, and has been the foundation of much of the base of your financial services sector. Does this mean you cannot compete? No. It is, all it simply means is that up till now you have remained largely, if not totally, dependent upon those quasi-rents that have been provided to you by foreign governments. In Botswana, we're more fortunate. It is, we have the birthright of nature. We have the richest diamond mines on earth that provide us with those quasi-rents, and hence production occurs, but nothing beyond that. Nothing beyond the extraction of those of our diamond mines. Now, the minister said you have developed a jewelry sector, which is, I understand, AGOA dependent, and therefore continues to be preference dependent. What I'm happy to hear is that their medical devices exports is not preference dependent. But that doesn't surprise me. We've just completed a study for the government of Botswana on where are the sources, the actual quantitative sources of our cost disadvantage. And it's surprising that Mauritius, which we have the actual cost data for, we hired the Economist Intelligence Unit to actually look at what Botswana's cost disadvantage was in comparison to its SADC partners, and you come out quite favorably. The situation isn't as dire as it may initially appear. And for a good consultancy fee, I'm sure BIDPA will be more than happy to share it with the Mauritian government. That's not me. I don't get this money. All right. No, none whatsoever, even for SADC trading partners. The important point, of course, though, is that you have an opportunity now. There is no disaster without opportunity. You will need to make major economic adjustments, and you have the important development of this global financial crisis that will allow you to make those shifts. And that will be painful. I have as much fondness for structural adjustment programs as the next person. But I know that they remain absolutely necessary in order to render Mauritius competitive. I hope you can reach a point where your factor prices and your productivity are such that it allows you to export competitively without those preferences. I don't believe it. But prove me wrong, please. Thank you very much, Mr. Chair.
Thank you. In fact, yesterday I was chairing another meeting where we had a gentleman that loves Mauritius and who lives abroad, and who told me more or less the same thing. And he went on, and since Minister Said Hussein is a friend of mine, I hope he won't mind me saying it. He said that if Mauritius goes at this pace, in 5 years' time you're going to have a full-blown economic and social crisis. I think that's a bit of an exaggeration, but I hope we're going to prove, the previous orator wrong when it comes back in 20 years' time. Now, this concludes the first part of the roundtable on the impact of the financial crisis on trade in goods and services, on macroeconomic indicators, on investment, and then obviously we got the insight and the perspective from Professor Greinberg on what Mauritius needs to do in order to remain competitive. The second part of the discussion revolves on policy responses that have been adopted by countries in Africa, in emerging economies, basically to mitigate the worst of the crisis, and also probably to restore economic growth and to rebalance the economy. And I've tried to divide it into 4 parts, and I've tried to assign 1 part to each of the panelists. The first one, obviously, is a national response. What has been the response of specific countries? And again, there is no one size that fits all. So it will depend to a large extent on how the country has been affected, and the policy response, will have to be commensurate with the gravity of the impact of the crisis. So Minister Said Hussein will deal with national response, and we know what these are: monetary policy, fiscal policy, specific assistance to enterprises, a range of policies that have been embraced in Mauritius itself, but also in other countries on the continent. The second aspect will be dealt by Professor Morrissey on what is a regional response in terms of South-South cooperation, in terms of speeding up the process of regional integration, and what lessons can we draw basically from the policy responses that have been embraced by countries on the continent. And the third one, obviously, if we function in a globally integrated economy, you need to fix the international economy. And what can the big institution and the big organization do in terms of the IMF, the World Bank, the G20s, and also how can the WTO unlock the problem that we are facing, with the trade issues. And last but not least, as it is again very challenging, I'll ask Professor Granberg to take us through the structural issues. He calls it economic adjustment, because we cannot lay all the blame of what's happening to us solely and purely on what's happening in the Eurozone. Surely there are some things that Africa can do, the region can do, Mauritius can do, in order to mitigate the adverse impact of the recession. So we'll start with Minister Siderson, who will take us through with the national response to mitigate the impact of the crisis.
Thank you, Dr. Sidanen. With your permission, just a small comment on what my neighbor, Professor Granberg, has just said concerning possible scenario in case we didn't have preference regimes. I think it would be anybody's guess. It would be anybody's guess what would have happened or what would happen